I think
Sure.
the issues at Credit Suisse are different than the issues at First Republic. And the issues at First Republic are different than those other three banks. The other three banks, David, that you mentioned, Signature, Silicon Valley Bank, and Silvergate, all had very traditional liquidity crises, right? We talked about this last week, which is duration mismatching, where you have depositors who want their money today, but you have assets that mature in 10 years. And as a result, you have huge unrealized losses if you all of a sudden cash them out today versus waiting 10 years. I think what's happening at First Republic is really just about making sure that that loan book and the depositors can get parked into a combination set of banks that can take care of the balance sheet so that there are no more liquidity issues. At Credit Suisse, they have an enormous amount of liquidity. What that was I think, a lot of speculation around whether they would default on their bonds or whether they would theoretically need more liquidity. But the balance sheet itself was not only liquid, but also very solvent. So I think that was just more of a panicky reaction to comments from a 9.9% shareholder who just said that they can't put in any more equity. But even then, I went back, this is the chairman of the Saudi National Bank. He was asked on Bloomberg, would you give Credit Suisse more money? And he had a very reasonable answer, but it was snapshotted in a very awkward way. The first sentence was, under no circumstances would he do that. Okay. Now, if you stop there, you could be panicked. But the rest of it made a lot of sense, which is he said, look, in Saudi Arabia, if we go above 10%, we have to go through regulatory approvals domestically, and there are regulatory approvals abroad. That's a big hill to climb. And all of a sudden, it no longer becomes a financial investment. It becomes a somewhat political investment. And so we're very happy at 9.9%. That was the totality of his statement. But if you just cherry pick the first 45 seconds and ran with it, which people on the internet did, this is sort of what caused that second level wave panic at a G-SIB. And then the Swiss National Bank stepped in, and I think that panic has largely gone. Okay, so what is the real issue? The issue, again, is I think we have had a bit of supervisory failure here, right? Because we all know this in any industry. If you let capitalism go totally unchecked, shareholders will demand immediate profits today. It happens in every industry, except in ones where you can basically gamble on future profits, and that's what tech does. But every other shareholder in every other asset class demands money today, and that's the same for banks. The problem is the banks are a highly regulated business. They are supposed to be supervised by the regulators. And this is a very clear example where why is there not a real-time spreadsheet? I mean, this is not complicated stuff where assets and liabilities and duration mismatching can be known on a real-time basis, where the San Francisco Fed, Mary Daly, should have a report that's escalated to her when SVB got over their ski tips, which they did in Q4 of 2022. So I think the real question that has to be examined is, where were these folks for the last 4 months when they could have done something, not just about this, but rules in general for all banks that are not the G-SIBs? And I think that's a very important question that politicians need to get to the root of.
Banking giant Credit Suisse is on the verge of collapse, which could be a catastrophic hit to the global economy. That's because Credit Suisse is one of only 30 global systemically important banks, or G-SIBs, and G-SIBs are interconnected to countless other institutions, so the failure of even one of these banks would send shockwaves into the global financial market. In a recent All In episode, billionaire investor Chamath Palihapitiya suggests that despite major bailouts, this banking crisis is likely to continue, and the Fed's recent actions could delay the inevitable reckoning for another year at best. Be sure to stick around to the end to hear Chamath and others explain the real causes of these banking meltdowns, what investors can expect in the coming months, as well as some steps that could be taken to prevent more failures like these in the future. Also, if you enjoy this type of content, be sure to hit the like button, subscribe, and click the notification bell so you don't miss any future videos.
You can't shut down the global economy and stop trade and stop people and have the government step in to write a giant check and not expect that you're going to have to cash that check at some point. That's effectively what I think we've been kicking down the road here. The way we initially tried to resolve the problem was to drop rates to zero and then spend our way, back to a growing, supported economy, and then overshot, ended up with, too much stimulation, too much stimulus, too lower rates for too long, responded too quickly, whiplashed back. At the end of the day, there was a giant gaping hole blown into the global economy when we shut down the world from COVID. There's no blame. It's just what happened. And when that happened, there was a massive cost that had to be borne at some point. And it's going to get borne at some point. And the rippling in a pond, you don't know where the ripple is going to hit, what part of the pond, what leaves it's going to hit. That's what's going on still. And it's such a dynamical system. It's so hard to say with linear certainty, this is what should be done and what could have been done and what they should have done at the time. No one had that predictive capacity back then. They did what they needed to do. People thought that they should have dropped rates. They said we should have written all these big stimulus checks. Some people said you shouldn't. Some people said you did. Certainly, some people are being proven right and some people are being proven wrong. But at the end of the day, the economic loss that was realized at that period of time, we're still trying to get out of it and we're still recovering from it. And I think that's a big part of what's being eaten up right now. And you're going to see it in the wipeout of certain equity. You're going to see it in the wipeout of these banks, of the assets that they hold and these portfolios. And the effects of that are obviously, still being felt.
I think that it's important to understand the facility that the Fed created. So what the Fed did this weekend is essentially create a buyer of last resort again. Now, how did they do this? So all of these banks basically have assets that they bought for $1 and are now worth 95 cents. And that's what's creating this whole issue, or 80 cents or 85 cents. You pick the number, but they're not worth the $1 that they bought it. What the Fed basically said is, okay, give me that asset, give me that bond. I will value it at $1 and I will give you $1 as a loan and you will pay me interest. And the interest rate, I think, is what's called OIS, and they added 10 basis points on top. So I think it's about 4.9%. So what it allows all of these banks, and if you take all of the banks that are not the top four in America, so the top four are JP Morgan, B of A, Citi, and Wells. So just ignore those for 1 second. The other N banks, if you look at all of the assets that are underwater because of all the rate hikes that Sachs talked about, and you add up all those losses, that is about $2 trillion. And the Fed didn't announce that there was a beginning and an end to this program other than saying these would be one-year loans. And so I think the exposure for the American banking system at a minimum is going to be this $2 trillion, because now the incentive, if you're a banker right now running one of these banks that has not gone under, is to immediately go to the Fed, put all of those assets to them, get a loan, and now take that and buy different assets, different bonds, different US treasuries that are yielding much more than what your old treasuries were yielding. And I think that's the arbitrage that we've unfortunately created. And the other question now, though, however, is what does that mean for the top four banks, right? Because if it's $2 trillion for everybody else but the top four, what's the gap for the top four? That looks like it's somewhere between $1 trillion and $2 trillion. So that's another amount of money we're going to have to, or the Fed will have to backstop. And then, as Friedberg said, these checks always come due. What do we do in a year? Because in a year, the problem is the only way to make the banks in a position to repay this much money in 1 year is to cut interest rates so massively that these assets massively inflate, and now all of a sudden you're in a position to cover this. So
and
it's
describe
what
that delta is, because it's about, they're down 15%, 10% in book value, these longer term treasuries.
It depends on the security. Again, it depends on what they bought. We don't really know enough detail, so I don't want to guess. But if you own these 10-year treasuries, you could be off 10 or 15%. If you own mortgage-backed securities, it could be off a little bit more. If you own short-term securities, they're off a little bit less.
But these are with the government.
You get a loan collateralized by these assets. So you're still holding them, right?
Yes, and they mature.
So if the Fed takes an emergency posture and says, okay, guys, we want to avert a crisis in a year from now, and we're going to cut rates, these assets that these banks own will be worth more, which will allow them to repay the loan. As far as I can tell, all we've done is we've kicked the can down the road for a year. But I do think it's important for people to realize this doesn't solve the problem. It just means that mark your calendar for a year from now. We have a problem on March 15th, 2024. Because all those
Perfect.
folks that took money, what do we do?
Yeah. And so a year to work it out, Freeberg, would seem like a good idea because the Fed is fighting inflation. They seem to have gotten some portion of it under control. It's not out of control, right? Inflation. And maybe if they can slowly, either start rate cuts or pause. So let's shift the discussion to, hey, what are the changes we need to make to the system and how do we think this plays out over the next year? Freeberg, Chamath had one suggestion, which was all of these banks should have a disclosure statement, mark to market every day, week, month, quarter, whatever it is. Just like Circle's USDC, their stablecoin, has a page with their disclosures of all their holdings. So that seems to be a very productive one. We should have them mark to market the Dodd-Frank stuff. As Sack said, Elizabeth Warren, probably correct. We need to reverse that. So those are two very tangible suggestions. What are your suggestions?
We need to have a real-time dashboard. We need to have a real-time dashboard at every single Fed that allows them, for every bank that they supervise, to know in real time. They
Should
can
the public
choose to
see that?
ignore it. I'm not sure that should be true, but they are their supervisors. They should see
Right.
it. They should choose to ignore it, but they should not have it.